Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And last week we obviously had a continuation of the trend deterioration that we started to see here a few weeks ago. Last week, I think the big event was the fact that the major S&P 500, NASDAQ 100 indices broke below the 50-day moving average. We basically got a pretty strong continuation throughout the week. We started off this week so far bouncing a little bit off of those lows. And I think the question on a lot of investors' minds at the moment is, have we traded down to an opportunity where now is a buying opportunity for the markets, or are we due for perhaps just a very short-term bounce before markets continue lower from here? It's hard to answer that second question, but the first question of expecting a bounce here, I certainly think that a bounce into the 5120, 5150 area is likely what we're going to see over the next few trading days. And we'll see how the markets react to that 5100, 5150 resistance level, whether we continue to break out higher from that and continue higher from here, or this becomes an area of resistance and the markets continue to roll over from those areas. So we'll take a look at different markets and look at the charts to help us understand how we are thinking about this question. So like I said, on the S&P 500 and the NASDAQ 100 last week, we broke below the 50-day moving average. That's a pretty significant event, and a lot of times that's associated with more of a bearish tone here to the overall market. But I do want to remind investors, as investors, our goal is to buy low, sell high. And when something is trading below its average, that means we actually have an opportunity to potentially buy at a lower price. So when things trade below their moving averages, statistically speaking, you have a higher chance of a move higher than a move lower. So I just want to remind investors that, when we think about stocks crossing below their 50-day moving average, we think of that as bearish, but we really have to rethink about the actual statistics of when is the best opportunities to buy, and they are actually when stocks trade below their moving averages. So the question is really, are we at that point where this is a buying opportunity? We'll try to kind of answer that question here over the next week or so. But at least in the short run, we found some support, and likely, I think in the short run, we'll get a small bounce here on equities. And the question is, as it starts to retest that 50-day moving average, does it manage to break out higher from there, or does it roll over and continue to move lower? And we'll take a look at some of the other charts here as well to help us try to answer that question. We saw this IWM small cap indices break down below the 50-day moving average the prior week. We saw the continuation last week, but as of Friday and as of Monday, we saw a little bit of bounce back here in the small caps, and we'll talk about that here in 1 minute. Equal weight S&P 500, as you can see over the past week or so, largely unchanged. This really speaks to the fact that the sell-off that we saw here at the end of last week was fairly concentrated in the higher beta technology names, discretionary names. It wasn't a broad-based sell-off here. And that's part of what's giving us a bit more confidence about buying this dip, is that this is not a broad-based distribution, that this is a distribution so far that we have seen from the high beta tech names. If we look at growth versus value, we've been talking about the fact that growth has outperformed value for quite some time here, but over the past couple of months, we have continued to see value outperform growth. And that's exactly what we saw here at the end of last week. The sell-off here was accelerated by growth names, and value names in turn actually outperformed growth names as a result of that. So again, the sell-off here wasn't particularly broad. It was really fairly concentrated in some of the sectors and industries that are currently trading at fairly rich valuations. We'll talk about as to why when we look at the interest rate charts. Commodities, we failed to break out above this $23 level here on GSG. We'll see here over the next week or so if this makes another crack at 23. But I do think in the short run, there's a possibility that 23 could become a short-term temporary top in terms of commodities, and we could start to see this roll over, and we'll kind of see that as we look at the gold and oil charts here in 1 second to help us better understand the potential outlook here for the commodities-based commodities asset class. When we look at high yield bonds, we also saw the breakdown below the 50-day moving average here in high yield bonds. It did manage to find support around the 75.5 level here. And so far as of last week, we actually got the bounce higher here. And this is also another piece of evidence that we look at when we think about, is this a buying opportunity? Bonds did not sell off with the rest of the equity markets last week. Bonds actually stabilized here and started to move higher here as of Friday and yesterday. That tells us that the sell-off, is not spilling over to other asset classes, that it really was just a pullback in those really high beta, high valuation growth names that saw a pretty significant contraction here over the past week or so. So this gives us confidence that the bond market is not pricing in a substantial amount of stress, that it's actually finding some stabilization, which gives us a little bit more confidence about this as a buying the dip opportunity. If you look at the VIX, another thing that we notice here, look at Friday's candle. We opened up at above the 21 handle, and by the time we closed, we were around the 18.5 handle. And this is on the back of a day where equity markets opened at the highs and closed at the lows. So when the VIX opens at the highs and closes on the lows, when the equity markets does the same thing, that's usually a good signal that we are near a bit of a market bottom, at least in the short run. And that's what we saw here, a continuation of that yesterday. And my expectation here for this week is that at least in the short run, when we look at the VIX and how fast it has collapsed in the last two trading sessions, it really reflects kind of a recession of the fears that crept into the market at the end of last week. Has subsided substantially here over the last two trading sessions, giving us a little bit more confidence as buyers in this type of market environment right now for equities. 10-year bonds continue to trade around this 4.6 level. Note that last week, despite the sell-off here, bond yields did not continue to rise. 4.6% is obviously a challenging environment for companies that need to refinance, a large amount of debt, or for those high beta growth names that have to discount their future earnings to the present value at a higher interest rate. That discount is just at a higher level, and that means the present value of future earnings is going to be lower. So that's the impact that we largely have seen from the markets. We have not seen kind of that spill over to other parts of the market. So again, looking at this on balance, things don't look so bad. That towards the end of last week from an equities perspective certainly felt a little bit panicky, but the other asset classes are not showing that same level of panic. TLT, long-term bonds, over the past 5 or 6 trading sessions, as you can see, has really traded sideways, hasn't sold off here alongside equities, again, showing us more common stability from the bond market versus what we saw here from equities last week. The dollar index broke out above this 105 level, that resistance level, and over the past week or so really has gone absolutely nowhere from there. My expectation is that you're likely going to see this probably start trading lower here in the next couple of weeks as it kind of consolidates around this 106 level here on the US dollar. Gold, a big move down here yesterday, around a 2.5% move here to the downside. We noted that as we continue to make higher highs in the last week or so, we did not continue to make higher highs in momentum. That is a short-term kind of divergence. That's a sign that in the short run, this move here to the upside is exhausted, and then we're likely going to see a bit of a pullback here. So we got that starting yesterday. My expectation is that here over the next couple of trading sessions, we will likely continue to see gold sell off here as kind of the demand for safe havens recedes a little bit on the back of, what looks like the Middle East escalating into a broader conflict. At the moment, seems that risk has receded a little bit from what we started to see here last weekend. So gold also selling off as a result of that. Oil, same thing. despite the conflict in the Middle East, we've seen oil shed about $7 over the past couple of weeks. We traded up to that $88 now. We're trading around 80, 81, 82 at the moment, just around the 50-day moving average. We probably will find a little bit of support here around this $80 level here on oil. This is the West Texas Intermediate contract. But if you look at supply here, it remains fairly strong here. We continue to see supply outstrip demand from the OPEC nations. We also see the US continuing to produce a fair amount of oil. And this is all continuing to pressure oil prices lower, despite the fact that, we have a pretty significant conflict going on in the Middle East at the moment. Looking at the sector ETFs, and this is really where I think that when we look at the overall sectors, there's a few that I think are worth paying attention to here in this particular week. So some of the ones that I think are worth paying attention to here is technology. Last week, we saw the big move here to the downside in terms of technology. As you can see, from a relative performance perspective, we're going back to October of last year in terms of relative performance. It's kind of quite poor. Momentum has turned negative here a couple of weeks ago, and we saw this continuation lower. But we're starting to get to some oversold levels, and that's really kind of a potential buying opportunity for technology. You have the same thing here in terms of discretionary. A sell-off here has sold off into that 170 support level here on discretionary. A potential opportunity for at least a short-term bounce here, but the relative performance of discretionary incredibly poor, and momentum turned negative here a couple of weeks ago. Consumer staples is another one that I think worth paying attention. Financials is one worth paying attention to. We had the move higher here last week as equities sold off, and as you can see, financials have really rocketed itself higher from a relative performance perspective. In a higher interest rate environment, we have seen some of the major banks outperform at the moment. So financials outperforming, consumer staples also outperforming. As you can see over the past week or so, as equity sold off, consumer staples moving higher here, that relative performance showing up here on the charts. So consumer staples and financials worth paying attention to. Industrials, also another one that I think is worth paying attention to. As you can see over the past week or so, industrials is still hugging that 50-day moving average, which really shows us the outperformance that industrials has had over the past couple of months since the beginning of February, going into its kind of third month of outperformance here at the moment. So quite a few different sectors worth paying attention to here right now. So a few charts that I think are worth paying attention to from an ideas perspective. First one here is Pepsi. As you can see, Pepsi here is just breaking out here around this 174 level here to the upside. And what you get is not only a breakout from an absolute basis, but also a breakout from a relative basis. Momentum remains positive here. You got the crossover here on the MACD. Everything looks fairly positive here for a continuation higher here for Pepsi. And you have to remember that Pepsi trades at a fairly reasonable valuation when we think about, at about 21 times forward earnings, given the fact that it, has pretty high margins for this particular industry. And growth expectations that are in the 7-8% in terms of EPS growth, 4% in terms of revenue growth. Trading at 21 times earnings is a pretty fair valuation for the stock, and I think has the opportunity to start outperforming here now that we've seen this stock break out here. The next one I want to take a look at here is Dexcom. Glucose monitoring stock recently pulled back to a major support level around 130 or so. We broke out higher here, came back to retest this level multiple times. I simply think that the risk reward favors a move here to the upside. When we look at Dexcom, this is also something that's currently trading at a rich valuation, but I would argue it's justified given the fact that it's expecting about a 35% EPS growth, 20% revenue growth here over the next year or so. It trades at about 75 times forward earnings, but Again, very high growth stock that is in this true leader in its particular industry of glucose monitoring, wireless glucose monitoring. They are head and shoulders above the competition, and that's why it trades at those valuations. And I think that this is the opportunity for some investors to potentially get on at a better level after the breakout here above this 130, instead of chasing it higher, waiting for the pullback here. And that's where your risk reward looks more favorable. Another one to take a look at here is Adobe. Adobe also recently has pulled back about 22% here over the past couple of months. But notice how we make lower lows in price over the past month or so has not been confirmed by lower lows in terms of momentum. We've actually seen some negative divergence. That means that the sell-off here is starting to get exhausted, that sellers are kind of there are fewer and fewer sellers left, and this is the opportunity for that particular bounce here. As you can see, as we continue to sell off here over the past month or so, the underperformance here really has just performed on par with the rest of the market. And we also have to remember Adobe, similar to some of the other names, Adobe currently trades at 26 times forward earnings, but it does expect 13, 14% EPS growth, about 12% revenue growth, and operating margins about 35%, some of the highest in its industry. So I would say this is a stock that's somewhat undervalued at the moment, especially if you think about AI hype. Adobe is certainly a leader in terms of software provider that actually has a product right now that they can monetize from an AI perspective. And I think that this is an opportunity to pick up this stock at a more favorable, reasonable valuation now that it's pulled back significantly in its in terms of its valuations. A few stocks that I also want to point out here. These are stocks that are currently trading at some more reasonable valuations. So Snowflake is one. This is obviously one that was at one point trading at some really rich valuations. But one of the things is that, as you can see, similar to that Adobe chart, what you have is a big sell-off here, $230 stock that's now trading at $147. But over the past few months, as it continued to make lower lows, momentum is actually moving higher. This shows us that this sell-off here is starting to get exhausted, that there are fewer and fewer sellers continuing to step in, and that gives you the opportunity for a big bounce here. Snowflake trades at only 18 times forward earnings, despite the fact that they're expecting revenue EPS to grow about by 25% next year. I'm sorry, EPS to grow about 18%, revenue to grow about 25%. This is a company that's not profitable today, and that's something to be aware of. But I think that's largely reflected in the valuation at only 18 times forward earnings. So, that's something to consider at the moment with regards to Snowflake. Okay. And I'll leave you with one last one, PayPal. I like PayPal. This was a $310 stock just a few years ago. It's now trading at $63. PayPal is trading at only 12 times forward earnings. And think about this stock. It's expecting EPS to grow about 13%, revenue to grow about 6%. It has operating margins around 16%, so it's really fairly high for a payment processor. A lot of payment processors tend to operate on very thin margins. PayPal has pretty significant margins that are better than their peers. So the fact that it trades at only 12 times forward earnings makes it downright cheap. And what you can see here is that, this has been forming kind of this massive bottoming formation, and it hasn't broken out yet. It hasn't broken out here around the $67, $68 level here, but that's really kind of what I'm shooting for in the short run, is that move up to that $68 level and that potential breakout. But however you want to draw your charts, whether you think of this as an inverted head and shoulders, you want to think about this as just simply a long kind of a bottoming formation that's been forming, or just, you know, you want to draw your lines much more simpler, you know, where it's just a simple trend line higher and you're looking for that bounce higher. There's quite a few different ways that you can draw these lines, but they all point to a stock that is currently in that formation of a bottoming formation, trades at very, very cheap valuations, despite the fact that, you know, it is quite profitable. It has continued to grow substantially and very consistently over the past few years. It has very little debt, has strong margins, generates strong cash flows, just an overall good business trading at a low valuation. And I think now is an opportunity to take a look at stocks like PayPal. So with that, that covers what I wanted to share with you here today. A lot to digest, you know, a lot of questions about whether or not last week's sell-off was an opportunity to buy. When we look across the board, across other asset classes, look at bonds, look at dollar index, look at VIX, it really kind of doesn't speak to a lot more fear left in the markets. And I think that means in the short run, we have a buying opportunity. We do have that outstanding question as to whether this buying opportunity is part of a longer term buying opportunity or this is just a short term bounce. Hard to answer that question right now. We have to see how markets respond to the levels of, you know, the next resistance levels as it gets there. But, you know, we'll continue to inform you every single week of what's developing in the markets and make sure you have what you need to continue trading. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.